We'll go ahead and get started. Welcome to everyone to today's 401k class. And today is all about cash balance plans. Um, we're joined today by three of the consulting actuaries here on the defined benefit team. My name is Leah Johnson. I manage the defined benefit cash balance team here at Definiti. So it's totally appropriate that today is cash balance day. You're going to hear, following my conversation, you'll hear from Dave Davala, who's a consulting actuary here at Definiti. He's going to be discussing the basics of cross testing surrounding cash balance plans. Then you'll hear from Don Boetger, who is going to speak about operating a cash balance plan. And then finally, we'll hear from Kevin Abrams, who's also a consulting actuary, to talk about the logistics of funding a cash balance plan. So we're welcome to all questions today. And we really look forward to this class and hope that this is greatly beneficial to everyone. And with that being said, I'll hand off to Dave Davala to continue.
Thank you, Leah. Let me get my screen shared here. Okay, hopefully my presentation is up. Thank you for joining us in this cash balance session, basics of cross testing. Before we talk about cross testing, I want to go over some definitions and ideas. Some definitions. Defined benefit or DB plan. It's a retirement plan where a participant's benefit is defined as an annuity payable for life or a specific period of time. An example is a percentage of compensation for each year of service. Another example is a fixed dollar amount per each year of service. A cash balance plan is a defined benefit plan. It looks like a 401k, but it is a defined benefit plan. It defines a cash balance credit, which is actually the present value of an accrued benefit. And in a defined benefit plan, the plan sponsor is responsible for the investment risk and the mortality risk. Okay, a defined contribution or DC plan, it's a retirement plan where a contribution amount is given to a participant. If the plan allows, the participant can direct the investments of their contributions. In these plans, the participant bears the investment and mortality risk. Highly compensated employee. This is an important concept when we looked at cross-testing. To be deemed highly compensated, and a participant must meet one of the following: owned more than 5% of the company in the current or prior year, or compensation greater than $130,000 in the prior year. This $130,000 it's a threshold, and it is indexed for inflation. The $130,000 is the 2021 threshold. And just last week, the IRS released all the new various pension limits, and this will increase to $135,000 for 2022. And family attribution applies to the HCE designation. So if someone is deemed to be HCE because of one of the two tests, and they have family also working at the company, their spouse, child, or parents, then they are also considered HCE. Their ownership or compensation doesn't matter. It's because they have that family relationship. And in the HCE classification, there's an optional top paid group election that can be used. Now, this is for an employer if they have many employees earning more than the threshold, like the $130,000, for example. And what you can do is if you elect the top paid group designation, then only the top 20% of employees based on pay are considered HCE. So you could have some, if you rank your employees, there could be some employees making more than $130,000, but if they're not in the top 20%, then they're not HCE. This can help with testing, as we'll see in some examples. Some more definitions. An important definition we're going to talk about, and as in examples, is the EBAR, the equivalent benefit accrual rate. And EBARs are used for non-discrimination testing. An EBAR is the accrued benefit equivalent of an allocation divided by compensation. To calculate an EBAR, a participant's allocation, like for example, in a profit sharing plan, the allocation is projected from their current age to their assumed retirement age. Then this amount is then divided by a life annuity factor, which is like turning it into an accrued benefit. The accrued benefit is then divided by compensation to get a rate, which is the EBAR. And when you divide by the compensation, you can use the current year compensation. You can also use average compensation. And instead of using just the current year accrual, you can use all the accruals a participant has had currently and in the past. Sometimes that helps with the testing. Discretionary profit sharing. An employer can provide a contribution to specific participants as long as it is non-discriminatory. We'll see this in the examples I'll show you later. Non-discrimination testing. Pension law does not allow a plan to discriminate too much in favor of highly compensated employees. The IRS has written regulations with various definitions and rules defining how not to discriminate. And one of the first things it says in these regulations, and I've quoted it here on the slide, is a plan is a qualified plan only if the contributions or the benefits provided under the plan do not discriminate in favor of HCEs. Safe harbors. There are safe harbors that can be used to avoid non-discrimination testing. So if your plan is designed as in the regulation, you don't have to do the testing. Cross-testing. Cross-testing is when you test a defined benefit plan on the basis of equivalent employer-provided contributions, or a defined contribution plan on the basis of employer-provided benefits. Another way to say this is test a DB plan as a DC plan, or a DC plan as a DB plan. And we'll see this in the examples. Okay, I want to go over some legal limitations. So there's limits on defined contribution plan as to how much a participant can have added to their account each year. The limit for 2021 is $58,000. This is indexed for inflation and will increase to $61,000 for 2022. This amount includes elective salary deferrals, employer matching contributions, after-tax contributions, and forfeitures. The maximum amount that a person can defer in salary each year is $19,500. That is the 2021 limit, and it increases to $20,500 for 2022. It's indexed for inflation. Now there's also the age 50 catch-up contribution. If a participant is age 50 or over, they can contribute or defer an additional $6,500. That's above those stated limits above. Safe harbor contributions. Here are some 401k safe harbors. A DC profit sharing plan that provides 3% of pay is the safe harbor plan. A 401k that matches 100% of the first 3% of employee deferred compensation, then 50% of the next 2% is another example of a defined contribution safe harbor. There's other safe harbors. I just wanted to mention these two. On Monday, there was a session hosted by Chris Wilson. If you missed it, the whole session was on safe harbor plans. So if you missed it, you can go back and watch that to get more details on these plans. Defined benefit plan limits. There are limits on how much a participant can receive from a DB plan. In the 401k, there's limits as how much can be put in. On a defined benefit, it's how much you can be paid out. And these are driven by Internal Revenue Code section 415. The 415 limit is the lesser of two limits. So you calculate each limit and take the lesser of the two. The first one is the dollar limit. The annual dollar limit on an accrued benefit is $230,000 for 2021. This is indexed for inflation and increases to $245,000 for 2022. Now, this is the amount that can be paid for the life of the participant. So they can receive this amount each year, every year for life. That's what the limit is. That's what it is limiting. Now, this amount is reduced for ages less than 62. So if participant's going to be paid out before age 62, then this limit is reduced. And it's also reduced for participation in the plan less than 10 years. So once the plan has been in existence for 10 years, then this limit can be fully recognized if somebody has been in there for all 10 years. And this amount is also increased for ages after 65. So if someone doesn't start collecting their defined benefit pension until age 66 or higher, then this benefit is increased. The second part of the 415 limit is the compensation limit, and it is the 3-year average compensation. And it is compensation during employment. So if a participant was employed before the plan came into existence, then you can use the whole employment history. You don't have to wait until the plan started to exist. And the compensation used to calculate the 3-year average is limited to the 401A-17 limit, which is $290,000 for 2021. It's indexed for inflation and increases to $305,000 for 2022. And what we usually see when a participant has 10 years of participation and the maximum compensation, then the dollar limit is the lesser of the two, because the $230,000 is going to be lesser than, whatever you're comp averaging. If you're averaging 290, 280, 285. But once the participant reaches age 67, 68, since the dollar limit is increased for late retirement, then that, and the actual increase on that can accelerate pretty quickly. Then what happens is that dollar limit grows quickly, and then the average compensation limit applies. Okay. Other requirements. I'm listing the maximum compensation again, like in the prior slide, $290,000 for 2021, $305,000 for 2022. This not only applies to the defined benefit plan, it also applies to the defined contribution plan. Okay, another requirement on a DB plan is minimum participation. This is defined under section 401A-26. This is for defined benefit plans. Simply put, you have to make sure there's enough people participating in the plan. It's like 40%, or if you have two participants, both have to participate. And by participating, they have to have a minimum benefit accrual. Something else that needs to be considered is the average benefits percentage test. This is a coverage test. You need to make sure the non-highly compensated average benefits compare favorably to the HCE. Minimum allocation gateway. This is something we deal with a lot in discrimination testing and cross-testing. There is a gateway that must be satisfied to cross-test the defined contribution plan. The easiest one to pass is where the non-highly compensated receive a minimum allocation based on what the HCEs receive. When testing a combination of a DB and a DC plan, there is a different gateway that must be satisfied. The most common and easiest gateway to pass is where the NHCEs receive a minimum allocation based on what the HCE receives. Okay, combined plan limit. This is the limit on total contributions to a defined benefit and defined contribution plan. The limit is based on total compensation and depends on whether or not the plan is covered by the PBGC. If your plan is covered by the PBGC, you can usually contribute more. Top heavy minimum. If key employees have 60% or more of the total benefits, then non-keys receive a minimum. If you're cross-testing a DB plus DC plan and it's top heavy, it is usually less expensive to fulfill the top heavy minimum in the defined contribution plan. Okay. All right, let's show some examples here. This is an example of a profit sharing plan. It is being cross-tested on a benefits basis. Each participant's allocation is projected to retirement age. In this case, I'm using age 65. It is converted to an annuity by dividing by an annuity factor and then divided by compensation to get the allocation rate. Let's look at owner one, who receives an allocation of $58,000, and NHCE 6, who has an allocation of $1,350. If you look at the allocation rates, owner one is receiving 20% of compensation, and NHCE 6 is receiving 13.5%. The average allocation rates for the HCEs is 12.94, and the NHC average is 6.68. Okay, let's look at the magic of cross-testing. We're going to calculate EBARs. Owner one has an EBAR of 2.9%. HCE 6 has an EBAR of 17.72. So if you can look to compare these to the allocation rates, owner one had an allocation rate of 20%, and the EBAR is 2.9, and HCE 6 has an allocation rate of 13.5, and the EBAR increases to 17.72. The reason NHCE 6's EBAR is so much greater than owner one's is because of the methodology of calculating EBARs. Each allocation is projected to retirement age, in this case, age 65. NHCE 6's is projected for 32 years, while owner one's is only projected for 5 years. And these allocations are usually projected at 8.5%. In the regulations, there's a range of interest rates you can use, and that's the highest rate. So that's what is used just about every time we do this. Okay, then each allocation is projected. Well, the projected amount is then converted to an annuity by dividing by the same age 65 annuity factor. So the annuity factor for owner one is the same for NHCE 6. And then once we get those annuities, they're divided by the current compensation. The larger increase factor because of age results in NHCE 6 having a larger EBAR than owner one, even though the allocation rate was lower. So age is an important factor when we're doing cross-testing. If we look at NHCE 5 compared to owner one, NHCE 5 has a lower allocation rate and EBAR. This is because NHCE 5 is 57 years old. The allocation is increased only for 8 years. By using cross-testing, the HCEs in this plan can receive 92% of the allocations. Okay, let's look at a detailed calculation for owner one and owner six. Owner one allocation rate is $58,000 divided by the compensation of $290,000, and that's 20%. The EBAR is the $58,000 times the projection interest rate of 8.5% for 5 years, divide by the annuity factor of 10.37, and then divide by compensation of $290,000 to get 13.5%. I'm sorry, 2.9%. And HCE 6's allocation rate is $1,350 divided by 10,000 for 13.5. The EBAR is the $1,350 allocation times the projection interest rate of 8.5% for 32 years, divided by the annuity factor of 10.37, and then divide by compensation of 10,000 for an EBAR of 17.72. Okay, let's look at another example. This is a cash balance plan being cross-tested with a profit sharing plan, and we're doing it on a benefits basis. Cash balance plans have what's called an interest crediting rate. The rate is defined in the plan document. For this example, we are using 5%. Each participant's cash balance allocation is being projected to retirement age. In this example, age 65 at 5%. The projected amount is then divided by an annuity factor to calculate a projected benefit. The profit sharing contribution is projected as in the previous example. Let's look at some of these calculations in detail. Let's look at owner one. Owner one's allocation rate in the cash is a cash balance credit of 78,300 plus the profit sharing contribution of 58,000 divided by 290,000 for an allocation rate of 29%. The projected benefit for owner one is the cash balance credit of 78,300 projected to age 65 at the cash balance crediting rate of 5%. It is then divided by an annuity factor of 12.804 to get 7,805. Now you may have noticed that this annuity factor is different than the one used in the previous example. Now cash balance plans have a definition of actual equivalence, and it's defined in the plan document. The definition includes an interest rate and mortality. The actual equivalence assumptions, these plan document assumptions are used to convert the cash balance credit to annuity. But when you cross test, you can use a different actuarial assumptions, so a different interest rate and a different mortality table. The projected benefit of 7,805 is then divided by compensation of 290,000 to get an EBAR of 2.69. The DC EBAR is the same calculation as in sample one and is 0.29%. The total EBAR for owner one is 2.98%. I'm sorry. Let's look at NHCE 6. The allocation rate is the cash balance credit of 150 plus the profit sharing contribution of 750 divided by compensation, which equals 9%. The projected benefit for NHCE 6 is the cash balance credit of 150 projected to age 55 at the cash balance crediting rate of 5%. It is then divided by the plan's age 65 annuity factor to get $56. Projected benefit is then divided by the compensation to get an EBAR of 0.56. NHCE 6's DC EBAR is the same calculation as in sample one and is 9.84%. Total EBAR for NHCE 6 is 10.4. Now these allocation rates I just shown here, these aren't used for the cross-testing. It's a good way to illustrate to the plan sponsor as to how much each person would be getting as a percentage of payroll. The contribution to the cash balance usually is the credit. It doesn't have to be, and I'm sure Don and Kevin will get into that in their sessions. Let's compare the example one and example two. Here we can see how combining a cash balance with a profit sharing plan and cross-testing, the benefits can increase for the owners of the company. By adding the cash balance, the owners can save more for retirement. They also save on taxes. The NHCEs do get a little bit more. Well, most of them do. NHCE 6 didn't. Okay, do we have any questions?
No questions in the chat box, Dave.
Okay. All right. Okay. I will stop my share, and the next session will be Don Boetger. Don is an actuary in our Erie, Pennsylvania office. You got the floor, Don. Thank you, everybody.
Well, thank you, David. Boy, oh boy, after listening to that, we work with this all day long. It sure is complex when you look at some of the nitty gritties going on with a cash balance pension plan. But what I thought I'd do on the next slide is just start with what are the new limits? David actually went through most of these limits in his discussions, but I thought I would mention a couple that he didn't mention, one being the maximum taxable wage base. That's right about in the middle. So that's increasing from 142,800 to 147,000 this coming year. So that's just where you pay your Social Security taxes on, or at least the retirement portion of the Social Security tax. The other items that you heard about throughout Dave's presentation is the annual compensation cap right above that. So we can count more pay now in 2022, if a person happens to earn that much, in calculating benefits and doing all this complex testing that David just went through. The other item of interest when thinking of cash balance plan is right below the taxable wage base, the defined benefit annual limit. So the annual pension limit, as Dave mentioned, is increasing to 245,000. That all we're really saying here is we have more room to put money into a cash balance pension plan, if that makes sense for you. Next thing I wanted to talk about on the next slide is really the relationship, the client focus. So we heard about rules and all of those we take care of for you. So it's nice to hear about them and understand generally what's happening. But what's really important for our clients is the coordination of effort, I think, between the actuary / consultant, your tax advisor, and your investment advisor. All three of us are working together to satisfy the client's needs. And it's real important up front to work together. And it's real important at the end to work together. And in the middle, there's a little bit of ongoing communication back and forth. But when you think about those rules that David just went through, that's the kind of stuff we do. And then we present it to the client, usually with the investment advisor and tax advisor, so that they know what kind of contribution arrangements can we make for this plan or these plans. Typically, there's two of them, a 401k and a cash balance pension. And that's where the client hears and the input of all the different parties and comes up with the right plan for themselves. Next, I guess you have to ask a basic question: is a cash balance plan right for us, for you? Well, it depends. You have to be financially successful. The whole reason we're looking to a cash balance plan is that you want more than a 401k plan. So piece number one of the puzzle is you have to be financially successful. Piece number two is your income has to be predictable. In other words, if you had a banner year one year, you may not want to commit to a cash balance plan because it's going to have required contributions into the future. If your income is high and is predictably, it should remain high, this might be just the plan for you. Of course, you're in a high tax bracket. That's one of the reasons to take advantage of a qualified plan anyway. So you have a tax deduction or deferral of taxes, technically, by putting the money in today, and then you're taxed later when it comes out, many years from now, either through a lump sum to your IRA or distributions out of the plan. The last piece of knowing whether a cash balance plan is right for you is if you have employees and there's favorable demographics, which really means the people you want to favor are older. So typically we have an older owner and a younger staff, and that's when you go back to David's calculations and crank everything through. What you conclude is you can favor the owner by an extreme margin oftentimes compared to the staff, primarily because they're older. And just the general concept, without going into all the calculations, the general concept is it takes a lot more money for an older person, for a deposit for an older person to have the same pension benefit than it does for a younger person who has many years to accumulate and let that grow for their retirement. That's the whole concept between cash balance plans, or traditional pension plans for that matter, to favor the older employees. Let me give you an example while we're here, is an age 60-year-old, for instance. I'm age 60. I'm very successful, and I'd like to save additional money for retirement, push down my current taxes and defer it to a later point when hopefully I'm in a lower tax bracket. We could design a plan for you that would put in as much as $264,000 in your name in retirement for your future. Then, however, if you back it off to age 50, that limitation drops down to 158,000, and at age 40, 95,000. So still can work at age 40, but as you see, as you get older and older and closer to retirement, that's when you can have significant contributions to a cash balance / 401k plan. So how do you design the plan? On the next slide, I really talk about the plan design and implementation. First of all, it's easy. You share what you want to do. What am I trying to accomplish? Sometimes we get requests, I want to maximize the owner and minimize everybody else. And that's what we go for. So we establish that. Other times it might be a slightly different objective. I want to favor this person or that person. But either way, we can design a plan that gives different amounts for different categories of employees. For instance, you might have owners receive 100% of pay as a cash balance credit. You might have their spouse at 50% of pay, and you might have staff at 3% of pay. Now, all this has to work out testing wise with age and so forth, but step one, share what you want to accomplish. Then our team goes back and we work toward that objective. We do everything we can to design a plan that would satisfy that overall objective. And we do lots of illustrations. They come in daily, at least more than daily. And we probably do a couple hundred a year, just looking at it and seeing, does this make sense for the client or not? Sometimes it does, sometimes it doesn't. But that's step one. We use those techniques Dave described under the cross-testing to see if we can get to those objectives. Then we come back to you. If we can pass all the testing and satisfy your objectives, then you look at it and you decide if the plan's appropriate. If you like the plan, we write a plan document, and we use pre-approved prototype documents. Basically, these are much like a 401k if you have a 401k plan already. Where you pick and choose the eligibility, who receives a benefit, how much that benefit is, when it's paid out. All of those features of a pension plan are picked and chosen on these pre-approved prototypes. And we like them because they're cost efficient, and also they're as flexible as possible, and you're within the IRS regulations. Now you have a plan, it's up and running, and we have to administer it and test it annually. So let's talk about that. What happens each year? On the next slide, we just have kind of an illustration of the different items that happen throughout the year. Oh, I'm sorry, I skipped a slide here. I guess most plans are 401k and cash balance combo plans. So if you thought about what David was presenting, what you concluded is it takes two plans to best design a program. One is salary deferrals in the 401k, so that you can save, and it's flexible, as much as you want up to the upcoming year's $20,500 limit. So that's piece one. That's flexible. Every one of your people decides how much they want to save out of their pay for retirement. Feature one. Feature two is typically the 3% of pay safe harbor. Now, Dave talked to you about two safe harbors. One of them was 3% of pay. The other one was a matching program. And I know myself personally in the past, I always liked the matching program because you wanted people to participate in this savings for retirement, and a match does a good job at enticing them to save. However, for cash balance 401k combo plans, it's almost always better to use the 3% of pay safe harbor. You're going to give everybody 3% of pay, whether they're saving any salary deferrals or not. Now, why is that important? It's important because we can use that 3% of pay in completing that testing that we were looking at earlier. So it gives us a leg up on satisfying non-discrimination testing, which makes it a little bit easier for us to design the plan just the way you want. Then I'm still in the 401k plan under the discretionary profit sharing. And this is where we design our profit sharing plans where it's discretionary. Employer decides how much, and the employer can even pick individually among individuals within the plan to receive greater or lesser amounts at their discretion. Now, we do have to test all those things, but the reason we make it that way or design the plan that way is because sometimes we need an extra deposit for a younger person in the profit sharing plan to satisfy testing. So that gives us and you the flexibility to pass testing without significant contributions. That's kind of our safety net there. Then lastly, a separate and distinct cash balance plan supplement. And that this is your traditional pension that looks just like a defined contribution plan, but operates different, has different limits. And that's where we can design the additional deposits for you to round out the whole picture. So that's a typical arrangement that we might end up with for our clients. So what do you have to do each year? On the next slide, there's a few things. One, you have to provide us the census data. The census data is given to us with date of birth, date of hire, date of termination, salaries, etc. I'm going to go through each one of these in a little more detail because I have a slide for each. Then we need to know the trust fund activity, your investment account. Then our team, the actuarial team, prepares the annual valuation. So we gather this information and come up with a report for you. It gives you certain information. Then you decide how much you want to fund into the plan. Remembering it's a defined benefit plan, remembering you have a target to attain to later, but you are going to have some flexibility in between. And lastly, the responsibility of an employer is to submit the annual reporting and also provide participant notifications. Let's talk a little bit more about the census data on the next slide. Not too difficult. Just provide us the information, the people's name, gender, date of birth, date of hire, social security number, we keep track, hours worked, that's important for vesting purposes. Usually we design our plans. It takes 1,000 hours in order to earn a year of vesting service. So that's important for us to know. And then we build on this each year and their current annual earnings. Where it gets a little more complicated is really the owner. And it can get complicated depending on the type of organization you are. For instance, if you receive a W-2, that would be a C Corp or an S Corp, we use that. That's what we use for your salary in the testing. Pass-through income of sub-S Corps doesn't count. So that's not counted for earnings in terms of qualified retirement plans. I guess if I stop on this topic, there's oftentimes we receive requests for proposals and the individual says, oh, I take a very low salary. I take maybe 40,000, but my pass-through is 300,000. Well, what we talk to them about is, well, let's talk about rearranging that. Maybe that salary should be $200,000. Now you pay a little more Social Security taxes, but that gives us the ability to do so much more within the retirement plan. So that's kind of, keep your mind open in terms of W-2 versus pass-through income of sub-S corporations. Sometimes the trickiest part is sole proprietors or partnerships in the net earned income. Often we would like to have the CPA involved. We like to have maybe your Schedule C completed prior to pension expense, because we have to come up with your income and to determine the contributions to the plan, but you need to know the contribution to determine the income. So anyway, it becomes a little bit more cumbersome, I guess, to come up with income when you have a sole proprietor or a partnership. But that's step one. So now we have information. Next slide is, well, what do you have in the plan? It's best for us to be duplicated on your asset statements. That way we get them electronically. You don't have to keep track of them and so forth. We receive them electronically, we store them. And what we use those for is they're used in the calculation, the funding calculations. So we're going to calculate liabilities by person or theoretical account balances in the cash balance plan, compare it to your assets, and tell you your contribution ranges, calculate those contribution ranges. It's nice to have those assets because we can see when you made your deposits, we can see how much the investments are growing or not in a particular year, and it just helps us do our work. So each year we reconcile those and summarize the activity. Then we'll move on to what we do for you is we prepare an annual actuarial valuation for the cash balance plan, and it develops a minimum required contribution. Kevin Abrams, our next speaker, is going to talk to you more about these contribution ranges, but there's going to be a minimum. ERISA, it's a traditional pension. You're going to have a minimum required contribution. Sometimes they're large, sometimes they're zero if your plan is very well funded. Then there's a recommended contribution. This one, we usually like to keep those theoretical account balances. That's how a cash balance works. It's a contribution. It looks like a 401k. It's a fixed rate of interest. It grows with a specific rate of interest, and you have an account, a theoretical account. And we'd like to we give a recommended that keeps you in line with that. We try to avoid surprises. Then lastly, you're going to see a maximum tax deductible contribution. And that is, some years you might have a banner year. You might want to pre-fund as much as possible next year or the following year's contributions. You can do that with cash balance plans. So they do have an element of flexibility as long as you're making the minimum required contribution. And we go through all that non-discrimination testing David talked about to make sure that everything is working and in balance. And lastly, we produce a participant statement of account balance. So I'll give you a real quick example. Let's say our example is we want to give the owner $100,000 a year that will grow with 5% interest. So at the beginning of the year, his account balance was 100,000. At the end of the year, it's 105. That's 100,000 plus the 5% interest credit. And maybe your staff will receive 5% of pay. I'm making up these numbers, but these are the kinds of things we see when we design these plans. Well, what we do then is that's the account balance, the theoretical account balance. Now we compare it to the assets and decide which one works, how much you should put into the plan with the flexibility I described earlier. On the next slide, you determine the appropriate level of funding. So basically, this is where you consider how well funded you are. So let's say I made that promise of 105,000 and I put in 100,000, but I lost 20%. So I only have 80,000 in the plan. Well, you're going to have to make that up over a period of time, either through investment return or additional funding, so that we end up with the 105,000 at the time it's to be paid out. So all this happens, and you think about where you're at. You think about the available funds you have, the tax implications, talking with your CPA. And then we just need to know the dates and amounts of the calculation of the contributions for calculation purposes. And you should remember that you can make these contributions all the way up until 8.5 months after your plan year ends, and they can be accrued for tax purposes. Now, you will have to go on extension to accrue them, otherwise they're due by your tax date. But even cash basis taxpayers can accrue the pension contributions. So I think that's an important point to know, is you have time to make these contributions. Of course, you can always make them earlier. Annual reporting is the next slide. Basically, under the annual reporting is, well, what do you have to do to report this to the government? Well, we complete for you something called a 5500 filing. It's the tax filing, or the information filing for the retirement plan. If you have a 401k, you're doing one for that, and you have to do one for the cash balance pension plan as well. The cash balance pension plan also has a Schedule SB. That's an actuarial statement. We actually complete it and sign it, that talks about the funded status of the plan, the assets, the liabilities, how much you put in during the year. Those types of things we report to the government. It comes with your 5500. We'll prepare the Pension Benefit Guaranty Corporation filing if your plan's covered by the PBGC. I'm going to talk about that in a minute, but basically you have to pay a premium. This is a government entity. You pay a premium when you have a pension plan, and the purpose of that premium is to guarantee the benefits if you should go out of business without having a fully funded plan. Then what you have to do is you have to sign it and then submit payment to the PBGC, that premium that I just discussed. Lastly, your responsibility is distribute employee statements so they know what they have in the plan, and any required notices, and we'll provide those at the end of the year. So what makes a plan subject to PBGC coverage? Well, in general, all plans are subject to the Pension Benefit Guaranty Corporation coverage, unless your plan is only for an owner employee. That could be a husband and wife. But if you only cover yourself, you're not subject to PBGC. You don't have to pay the premium, and you just go on and fund the plan as normal. If you're a professional services organization and have less than 25 employees, or 25 participants, for example, doctors, lawyers, CPAs, architects, etc., you're exempt from the Pension Benefit Guaranty Corporation coverage. One of the areas that I found is a little confusing is you think of investment consultants and you say, well, they're professionals, but not always. So if we have an investment advisor that wants to put in a cash balance plan, we usually go to the PBGC to determine whether they're covered or not, because it depends on the structure, and I don't know all the details, but all I do know is that it depends, depending on how you earn your income and otherwise. So it's always a good idea, if there's any question, to go to the PBGC and get clarification up front. What should you pay attention to on the next slide? I guess I know if you have a plan, you want to pay attention to a few things. First, changes in the employee demographics. I told you earlier how younger employees compared to older owners is the most favorable results. Well, that's true and will continue to be true. But let's say you're a small company and you have a 35-year-old that decides to do something different, and you replace them with a 55-year-old. All of a sudden, all that testing we've done in the past isn't turning out as favorable as it once was. So anytime you have a change, let us know. Now, you let us know at the end of the year with the census, and we're going to observe that, and they're not eligible yet, but we'll want to take possibly some action, because that could dramatically change the results for you. But so you keep your mind on that. Significant changes in investment performance. Remember, this is a defined benefit pension plan. We have a target that we're funding for. Sometimes it's the maximum target, and big changes in investment performance change your contributions if we're not on track for that target. This doesn't mean a whole lot early on in a plan, but it means an awfully lot as you get closer to retirement. For instance, these last couple of years, who would have expected the performance that you've received? Let's say you had a 20% return on your pension fund. All of a sudden, you probably went from an underfunded plan to an overfunded plan. If you're younger and have years to go, it's not really a problem. We just ease up on the contributions, put in less, and end up at the same target. But if that happens in the last year of your plan, when you're ready to retire, there's some maneuvering that needs to be done. So we look at it, can we amend the plan, improve it, change it to use up this excess? Because if you have too much money in your plan, you have to revert it back to the company, pay taxes on it, and there's excise taxes, at least 20%, but maybe 50% if you don't have some sort of replacement plan or sharing of that excess. So anyway, pay attention to that. Investment performance, especially in the later years of the plan. We can always amend your plan if objectives change. You aren't locked in forever. Now, you shouldn't amend it every year, but you should look at this and say, this is my goal and my objectives today, but if those change in 3 years, we can amend it, cut it back, increase it, whatever's appropriate. So it can be changed from time to time. And I know I say this over and over again, but as you approach retirement, pay close attention to the funded status of the plan. Going way back to the beginning where we talked about your investment advisor, your CPA, and us, this is where more attention should be paid, and we should work together for our clients. Plan termination. So the plan's doing its job. When do you discontinue it? Well, you might do it when the business is sold. You might do it if your business goes down and the plan is too costly. You can always freeze a plan and terminate the plan. You have to promise what was guaranteed under the plan to date, but the future of it isn't promised. So you always have to take care of the past, but don't have to commit to the future. Or most often the plan's just run its course. So that 60-year-old that I talked about earlier in the presentation is now 65 and maybe wants to retire. He's filled up his bucket and he wants to take it and discontinue the program. That happens more frequently than anything else. Well, how do you terminate it? Oh, I mean, you have to amend it to terminate it. That makes sense. It's a board resolution or decision to do that and amend the plan. You have to tell the people in the plan that have a benefit that you're going to be discontinuing it. They'll receive a package and it'll show them their cash balance account and it'll show them their monthly annuity if they prefer a monthly annuity. Almost always people take the lump sum, roll it over into an IRA, hopefully, and then take the distributions out of the IRA like any other IRA. The plan's covered by the PBGC. There's additional filings. You have to let PBGC know. You have to let them know if it's sufficient. And you also, after it's all paid out, have to confirm with them that you've paid all the benefits due under the plan. Sounds kind of simple, but it takes time. And the reason it takes time, several months actually, probably as many as 8 months to a year for a PBGC covered plan, is because all of these items and notices have various time frames in front. In other words, you have to let people know 60 days in advance that you're terminating the plan. So that adds 2 months. Then you have to give them 30 days to think about their option, lump sum versus monthly annuity. That's 30 days. And you have to do other things in the middle. So that's why it's never as quick as you might like. A lot of times you say, yeah, I want to terminate. Let's pay them out tomorrow. Unfortunately, it takes a little bit more time than that. And that's really, I think, the conclusion to my part of the plan, or the program. Cash balance plans are great. You can put in significant contributions. The testing is complicated, but we do all that for you. And if the plan works for you, that's what we'd like to provide for you. So that's the service Definiti provides. Do we have any questions at this time? If not, I see I have just a couple of minutes. I think I'm going to mention something that is unrelated to cash balance plans, but I always found it interesting many years ago and still find it interesting. And it's really related to Social Security benefits. I don't know if you know this or not, but you know how if you make $50,000, you pay a tax rate of 7.65% of the 50,000. Well, 6.2 of that goes for retirement. And if you make 100,000, you pay twice that amount. If you make 150,000, well, that's a little bit over the cap, but it's almost 3 times that amount. Well, the other thing that was indexed when we were talking about the new limits is something called Ben points. And I don't know if you know this or not, but when they go to calculate your Social Security benefit, they have different points. They give more credit to the lower wage earners. They want to have a basic standard of living for everybody. So what they do is if you make under $1,024 per month, now this is a 35-year average, you would receive a benefit of 90% of that when you retire. Then that phases down to 32% on the next 6,172 a month, and anything over that is at 15%. So I just find this interesting why we can do some of these things in retirement plans to favor highly paid is because Social Security is the opposite. They favor the lower paid. So when you look at it in the aggregate, it's a little more balanced. So that's just for what it's worth. Well, this time then, I think unless there's no questions, I'll turn it over to my friend and colleague, Kevin Abrams. And Kevin's going to talk to you. The final segment of the cash balance discussion would be the funding requirements, funding cash balance pension plans. So thank you.
All right, thanks, Don. I thought it fitting that you've turned your camera off by now, but you had a little, the way the light was hitting you, had a little rainbow reflecting. There it is. So there's some analogy there, I guess, for retirement and at the end of the rainbow. So, but thanks for handoff, and thanks everyone for being here this afternoon. My name is Kevin Abrams. I'm a consulting actuary here with Definiti, as Leah said at the top, along with Dave and with Don. And not surprisingly, a lot of the information that covers these plans overlaps. So basically what my session is going to cover is just kind of making sure you've been paying attention, because there's a lot of overlap with what Dave shared and what Don shared. So forgive me if I've repeated anything, but these are obviously important facts. So let me go ahead and pull up mine. Let's see. Share that. All right. So what I'm going to talk about is generally from day one, we want to sign up this pension plan until the end. Don just spoke before me and he covered a lot of those bases. So again, there may be some repetition here, but these are obviously very important concepts that we want to be aware of from the beginning of the plan's life until the very end when we're ready to shut down and pay everybody out. So example number one, this is a slide that Don just showed a few minutes ago, just who is a good candidate for sponsoring a defined benefit cash balance plan. And right now I say defined benefit cash balance. I'll delineate between the two in just a few minutes. So obviously the ideal candidate is someone that has a successful business. They have a steady, predictable income from year to year. Kind of like what Don said a few minutes ago, it's not necessarily just a big windfall in one year. And if you're an attorney and you win a big case and you have this big influx of cash, we can make those work. And obviously it's just, there's always depends when it comes to these types of plans, but generally we're looking for something that is a multi-year commitment, and generally you have the income to be able to support that. And the bottom part right there, as Dave kind of pointed out in his session, we definitely cater to all types of plans. There's the plans that we have where just the sole proprietor, it's a single owner, or as a spouse, owner and spouse, 2 business partners. And then majority of the plans that we have an employee, have 5 employees, have 10 employees. And we can still design these plans to be lucrative for the plan sponsor, who's of course in charge of the plan. But of course there's discrimination requirements that Dave went through that we have to account for. usually combining the cash balance plan with the defined contribution plan. So I'll start real quick, and this should be a basic example, but in this example, I'm going to just compare the difference between the possibilities of a defined contribution plan versus what someone can get in a defined benefit plan. So Dr. Smith is my example. She's age 50, and this year she's pulling down $290,000 in W-2. No employees wanting to worry about that for this conversation. So her options are do nothing, no retirement plan at all, no savings, and no tax deduction. So, excuse me, that's probably not the ideal way to go long-term thinking. So she can add this defined contribution plan that I've shown here, and I won't do another slide with all the limits because that Dave and Don already showed, but the maximum annual addition in a defined contribution plan is obviously limited. And as you can see here, assuming that based on the fact that she's age 50, so she can put in this catch-up contribution that many of you are probably familiar with, the most that she can put in for 2021 on behalf of herself and as the practice on her behalf is $64,500. And so between the contributions that she's putting in from her own W-2 and the contributions funded on her behalf from the company, that's approximately 22% of her W-2 compensation. Certainly a great tax savings, certainly great retirement savings. But of course, the question is always, is there more? And that's where we want to talk about a defined benefit plan. So in a defined benefit plan, let's look at the same situation. Dr. Smith here, the same age 50. And while the Internal Revenue Code limits a defined contribution plan, you look at the page and it says this is the most that someone can put in for a year, whether they're 10 years old or 90 years old, or to an extent. Okay, sorry. In a defined benefit plan, it's all dependent upon ages. So a 50-year-old can potentially have a much higher contribution to the plan, as you can see here. I think Don quoted a 50-year-old, the maximum lump sum that they could put into a DB plan for the first year around 158, I think you said. So there's a little gray area because there's all these underlying variables, but basically we can look at the fact that if compared a defined contribution plan to a defined benefit plan in this one particular year, additional savings of almost more than double what you can get in the 401k defined contribution plan. And as things progress over year, Dr. Smith would be able to potentially put in that same amount, $162,000 per year as we continue on. So it's not just a one-time blip. And as you can see, the hypothetical contribution that she could technically put in is over half of her W-2 compensation compared to under a quarter. So just to summarize here, the defined benefit plan obviously is the main theme here, that it affords her a higher deduction, which is important on the near term, and it allows her to put away more for retirement income down the road. So, and hold your laughter please, but the fundamentals, and I put fund in quotes because obviously we're talking about funding here. I'm just going to go over a few baseline things. Some of them have already been covered already, but obviously this, like all qualified plans, like a 401k plan that many of you already have, this plan is established by the employer. They're the sponsor, they're the fiduciary. They generally make all the decisions for how the plan is designed and set up, along with us and the different parties involved. Generally, all the plans that we have are the contributions come from the employer. There are defined benefit plans that are out there somewhere. They're generally, in prior decades, they were more popular that require employee contributions, similar to like a 401k plan. We don't administer any of those. And for the rest of this presentation, I'll just go on the basis that every contribution is funded on behalf of the employees from the employer. And again, not to belabor the point, but the last three items kind of tie together where it just says, this is a defined benefit plan. In a profit sharing type plan, you're the employer, you give your employee $1,000 as a contribution. They have it in their individual account, and it grows as they allocate their investments. And if it grows or if it drops, in so many words that that's a tough situation. But the requirement is not on the sponsor to make up for any losses. In a defined benefit plan, as the name implies, the benefits are defined. So that you look at a plan document, it doesn't say, oh, in any given year, John Smith can have a benefit of whatever I say it is, or depending on my profits this year, John Smith is owed a benefit of $100 per month for the rest of his life, or whatever the formula is in the plan. So basically the plan is defined as the name implies. So there's different options, and Dave kind of spoke on this a little bit. So, the typical defined benefit plan says this employee comes work for me. When they retire, they'll get $100. This is just an example, a simple example, but $100 per month from the day they retire at age 62 for the rest of their life. Well, in our world, in the small market world, the annuity is a lot less prevalent. And so a lot of the times, instead of saying, okay, employee that you've just left me, you've just left our company, and here you have this promise of a benefit for you, a monthly benefit for the rest of your life in 12 years. In this example, a 50-year-old that will start to take her annuity payments at age 62. Well, a lot of times they'll say, well, what is the value of that today? That's a more tangible number. What is the lump sum present value of this? Meaning, that payment stream that's supposed to start at age 62 for me until for the duration of my life, they using mortality and interest rate assumptions that are just some boring, behind the scenes actuarial stuff. We can calculate, well, what is the value of that today for that 50-year-old? We can say, well, we expect you to take 12 payments a year of $100 for however long a 62-year-old is expected to live. Well, what is that today? And age 50 for 12 years before that in a lump sum value. And in our market, almost 100% of the time, the interested party cares more about the lump sum value of what is my money today rather than what I'm going to get 12 years from now on a monthly basis. And so that's the actual equivalent lump sum. So like I said, most parties, whether it's the participant reading their annual statements or the plan sponsors that are thinking about what their contribution is going to look like, or the advisors that are on the case that are working to grow the investments over the course of the plan, for all intents and purposes, we generally view this benefit as a lump sum rather than an annuity, because that's generally how they get paid. So even though the foundation of a defined benefit plan is an annuity, as we've talked about throughout this afternoon, it might be a little easier to tailor this plan such that the defined benefit is actually in the form of a lump sum, which is a little bit more English. It's similar in ways to a profit sharing 401k type plan. I think that Don noted. Obviously, there's plenty of differences, which is why they're a type of defined benefit plan. But cash balance plans have become more of the norm rather than your traditional annuity benefit plans. And that's partially because they are a lot easier to set up, to administer, to understand what's going on from year to year. So how does it work? Rather than defining that monthly annuity down the road that someone could take out, we basically just say, we write into the plan document that each employee, there could be several different groups. There could be an owner group, there could be a spouse group, there could be an excluded group. There's a formula that applies to each participant that says they get a contribution credit applied each year. That has nothing to do with any investments. That's based on how the plan is originally designed. And usually when we have these cases, as the plan sponsor, who's basically the main target of this plan, the owner, the main principal of the plan, will be set up with a significant contribution credit. And in most cases, the other employees, unless there's special requests that Don had mentioned, usually the employees have a much more modest contribution credit that just is needed for compliance testing. So that contribution credit, say it's $100,000 per year, that gets earned every year that the participant works 1,000 hours, and that goes forward with interest credit. And that's a guaranteed rate of interest, and that's written into the plan provisions. Generally, we have a fixed rate of interest between 3% and 5%, which is fairly conservative, obviously. And those credits, the contribution credits and the interest credits, accumulate year after year, and basically they accumulate to what we call the hypothetical account balance. We say hypothetical, Don, I think, called it theoretical. A lot of odd names there, but that's basically because, as opposed to a 401k type plan where I can go onto John Hancock and look at what my current balance is based on my investment allocation that I selected, the hypothetical account balance is basically something that Definiti, as the TPA, as the actuary, tracks year by year based on the guaranteed rate of interest credit and the contribution credit, which can either be based on a flat dollar amount or a percentage of compensation, depending on how the plan is designed. So of course, if reality played out the way our assumptions did, which does not happen, I can tell you as an actuary, the idea would be the employer would fund a contribution each year equivalent to that contribution credit. The underlying investments, the way that the investments are set up, would grow at 5% or whatever that interest crediting rate is. And at the end of each year, we have an apples to apples comparison. The total assets in the plan based on the contributions and investment return would equal the hypothetical account balances, and we could be on our way, and I wouldn't have much need for a job. But obviously there's other circumstances that come up. For example, as I'm showing here, if the markets turn south, like they did, in March 2020, a lot of our pension plans saw significant asset losses. And granted, much of that turned around throughout the latter part of 2020. But the point is here, the contribution credits, the hypothetical account balances are guaranteed because it's a defined benefit plan. Losses, as opposed to a 401k plan, losses that are, on the employee themselves are on the hook. In this plan, the benefit is guaranteed, and it's the sponsor that would potentially have to make up any losses, which I'll talk about next. Okay, just real quick, an example of what the language looks like and numerically what it looks like. Here's Dr. White. Her compensation is $200,000 every year, similar to the prior doctor I had at the top. And we've designed the plan and based on what her goals are for deduction purposes, what she has available, what she expects to, how long she expects to have the plan. We've set up a contribution credit of 80% of her compensation. And the plan's interest crediting rate of provision in the plan is set at 5% per year. So that's all written into the plan document. There's an interest crediting rate that's, that's filled in that pre-approved document Don was talking about. And then we have a section where we define the contribution credits for Dr. White and other employees. They can obviously have different contribution credit amounts. So in numerical terms, in this hypothetical situation, we're starting in 2021 with zero balance. Dr. White has nothing when the plan is first effective. As of December 31st, 2021, she gets 5% of zero, which is obviously just zero, and she gets the contribution credit of 80% of her compensation. Moving that 1 year forward, just to see how the pattern continues, she'll then get 5% of her 12/31/2021 balance, plus another contribution credit based on what she earns compensation-wise in 2022. And the hypothetical account balance continues to grow as long as the plan is not terminated, which obviously would cease all that. Or if the plan is amended and maybe starting in 2024, Dr. White says, hey, I want to be a little more aggressive and I want to amend my contribution credit to 100% of compensation. And so that's just basically the accumulation of how the hypothetical account balance grows. So we're interested in actually the cash, like how deposits are formulated and what goes into the plan. So like I said before, if the reality played out like assumption, what the plan sponsor would deposit each year would be equivalent approximately to the contribution credits. And the interest credits that are guaranteed to all the participants, that would be made up by the investment return. But obviously, reality doesn't play out like assumption. In this example here, kind of a different assumption or a different example. In this plan with the employer and then their employees, the total hypothetical balances as of the end of 21 are 400K. And that's just, the accumulation of however long the plan's been active, the accumulation of the credits. Based on the prior deposits and the investment returns, the asset value at that time is 300,000. Simple arithmetic, we would do our valuation, and the recommended balance or the recommended contribution, we would say for the year is $100,000. And we just, we're looking through our actuarial prism. We're very narrow-sighted. When we come to our recommendations, we're just looking at the liability versus the assets, because obviously we want to make sure the benefits that are earned by everybody in the plan, the liability, is fully funded via contributions and investment return. So I have a little note here that just says that if we have consistent demographics, meaning there's not a lot of coming and going, there's not a lot of turnover, employee compensations tend to stay similar year in, year out, it will be fairly predictable to estimate what the annual cost will be on a yearly basis. Because if my contribution credit is 50% of my pay and I have the same pay, I project to have the same pay year in, year out, well, we can pretty much guess what 50% of my pay will be in all future years. So there's generally will be consistent contributions as long as reality plays out like assumption, which I can't say that enough. It obviously doesn't. Well, that's kind of boring. Why do you hire Definiti, and why does the actuary need to sign the Schedule SB? Well, under the Pension Protection Act, which is about 12 years now, they changed the way the funding calculations work in these defined benefit cash balance plans. And even though we say, how I highlighted here, we say we recommend this amount to fully fund your plan, we're only one piece of the equation. Don had that little exhibit that said, we work obviously with the plan sponsor, and we're working with your CPA, we're working with your financial advisor. That may not be the goal for this particular year, is to fund this 100,000. Maybe you had a boost in revenue this year and you have a lot more taxable income than you otherwise would. Well, even though the 100,000 will make the plan assets and liabilities apples to apples, maybe a $200,000 contribution this year is more pragmatic for your situation. Because the Pension Protection Act allowed a range of contributions, this minimum and maximum, generally the minimum will be below the recommended amount, and obviously the maximum will be above. Any contribution within that calculated range, which is what Definiti is responsible for, anything can be contributed and fully deducted in that year. So that gives a little more flexibility rather than just contributing the same old amount year in and year out. This is another point that Don kind of touched on. We do an annual valuation each year, and we provide this calculated range of the minimum and maximum contribution that you can put in to stay compliant within the IRS requirements. As time goes on, as the plans age a little bit after the first few years, that range tends to open up more and more. And so sometimes we have plans where the recommended contribution is 200,000 and the maximum is somewhere over $1 million. Now, that's not necessarily, we don't necessarily recommend, obviously, that you would fund that much for reasons I'll get to in a little bit. But over time, the range tends to expand. Certain factors that come into play that would affect the minimum and maximum range when we do our valuation is obviously prior year asset performance. This example has been used a number of times, but if we assume that the assets are going to grow at 5% and they lose 10%, that's a 15% swing. And in general, that investment loss will need to be made up through future contributions that are the onus is on the employer. Additionally, historical contributions. We, in that simple example I was referring to before, the recommended contribution would be 100,000, and taking investment returns out of the equation, if we're shooting for $1 million lump sum at retirement age, and we sign up a plan sponsor who's 52, and they're going to have 10 years of contributions, they want to get to that million. Again, ignoring investment return, we would say, okay, you can put $100,000 in per year for 10 years, and that'll accumulate. We're going to what I just said a few minutes ago. If it's a significantly successful year and you have more taxable income that you want to put in, perhaps in 2022 you put in 150,000, so which is more than what you ordinarily would and what the plan has laid out for you. And if you put in a little bit more in one year, then maybe the next year you carve off a little bit of what you're used to funding, and it'd be maybe a little less than 100,000. I'm sorry. So basically, the point is, as opposed to a defined contribution plan where you fund 1 year, it grows, and you don't look back. You're just worried about the current year and the future. Here, in a cash balance plan, everything plays together. What you do in year one, in some way, will directly impact what happens in year 8. So it's definitely a cumulative process that we're looking at. And obviously, as like in a defined contribution plan, you hire new people and they come into the plan and you're covering them. Of course, that'll increase your costs, which would in turn increase the minimum required contribution in that given year. So we're talking about here there's two prongs of setting up one of these plans. The first prong is, why do retirement plans exist? We want to save such that when we stop working down the road, we want to have a sufficient retirement income to support us. Additionally, if you have employees, while I wouldn't call them an afterthought in this case because they are getting benefits, the goal is to mostly benefit the principal owner of the plan and get them a satisfactory retirement. In addition to that, there's also the added bonus of that tax deduction, which is why most of you are probably here today, because in the near term, that's very important. So in that prior example, I'll go to, that the recommended amount, the assets versus the liabilities, is 100,000 for that year. However, the maximum, like I said, could be way higher than that recommended amount based on how our back house calculations work out. So the natural kind of begs the question, why wouldn't I just fund the maximum every year? It's within the calculated range. It's fully deductible. What's the catch? Obviously, we want the investments to grow. I'm just going to keep throwing money in as much as I can. But that's not always the goal. So the IRS defines these retirement plan limits that Dave talked about a little bit up top. In the defined contribution plan, they limit what you can put in. So as I said here, the limit in 2021 was 58,000. Obviously, with that example I had earlier with the doctor had the catch up, so it was 64.5. For defined benefit plans, there's obviously limitations to what you can put in, and that's what we calculate each year. But what the IRS defines as their limits when it comes to benefits is what you can take out. Dave had mentioned the annual annuity limit, which is $230,000 per year, which is the most that someone can take out of the plan as an annuity. However, like I said, a lot of these things we look at as a lump sum. One second, please. We look at this as a lump sum, and therefore we want to know how much the assets can grow on a lump sum basis rather than looking at that annual annuity. So based on that $230,000 maximum annuity that Dave was talking about for 2021, if we take the present value of that, the maximum that someone could take out of the plan as a lump sum is about 2.95 million. And there's a lot of different boxes to check. They have to be a certain age. They have to have participated in the plan for a certain number of years. They have to have historical compensation, which many of our principal owners in these plans can check off. Just to point out, if someone is not 62 years old or younger, or they have 5 years in the plan rather than 10, or they don't have the historically significant compensation, in the 200, 300,000, then that 2.95 will be reduced. For purposes of this example, I'll talk about a one-person plan in which the owner checks all those boxes. So we've come to the end of the plan. That hypothetical account balance has grown to 2.95 million based on assorted contribution credits, interest credits. And the IRS says that's the most that person can take out of the plan. Good. I'm good that his plan benefit matches the IRS maximum. Well, historically, the plan sponsor has been putting in the maximum because the plan allows you, the funding rules allow you to overfund the plan on an ongoing basis. So they've been funding the maximum, which is more than the recommended that we talk about each year. And the investments have hit out of the park. Instead of a 5% return, they've returned 15%. And the plan assets at the time they want to terminate the plan are 3 million. Well, Don touched on a little bit when he was talking about the plan termination process. If the one participant in the plan can only take out 2.95 million, but the plan assets are 3 million, what do we do with that extra $50,000? We have to find a home for it, and that's not in the IRA of that one person because they are capped out. So that could cause problems unless there's certain remedies that we come up with. The main approach, the primary approaches are shown here. The default approach is essentially that $50,000 that can't be paid out to that owner because they're already capped out. It reverts back to the company. There's ordinary business income on that 50,000. That 50,000 is treated as ordinary business income. Plus, they have an excise tax, which just goes straight to the IRS. It's nothing that Definiti is handling. Nothing that that we set. It's nothing that we gain from it. So we don't like to have any asset reversions. But that's basically the IRS's way of saying you put in too much or you invested too well. So this is our way of punishing you for having too much in the plan, more than we say you can have. So a way to avoid this is to either soak up that excess 50,000 if there's any other participants in the plan who aren't already at their limit, like this person in this situation is, they're already at the 2.95. So if you have a spouse that's, their plan benefit is somewhat muted, but their maximum is in the $2 million range, perhaps that person can just absorb that excess $50,000. Alternatively, and this is what we see most commonly, is a transfer of that surplus to a replacement plan, which is a new or existing defined contribution plan. In this case, that $50,000 would be transferred over to this existing or new defined contribution plan into some sort of suspense account. And basically that $50,000 can be used towards future years' employer contributions, such as profit sharing or safe harbor. And as long as that's fully used up, there's no excise tax because there's no surplus anymore because it's fully used up. So that's just the idea is we want to shoot for as high of a account balance or investment account balance as we can, but it's within limitations. It can't just, if we have $1 billion in the plan, that's wonderful, but there are certain limitations of what you can take out. So how do we avoid becoming overfunded? On Don's last note, he noted that early in the life of the plan, it's a little less important. Of course, we always want to be aware of this, but it's more a conversation to have when you're a few years out from terminating the plan and not the day of when I say, oh, I want to terminate my plan, and now we're going to think about this. So one way to avoid having an overfunded status where you have a potential excise tax at the end is to work with your advisor to have a more conservative investment return than maybe you otherwise, a conservative investment allocation than you otherwise would, in a profit sharing plan. I put the contribution in and I want it to grow as much as it can. I want it to return me 100% per year. And a DB plan, that's kind of the one retirement vehicle where you don't necessarily want that, because like I said throughout, we're shooting for a final asset amount for when the plan terminates. In this prior example, we're shooting for that 2.95. How we get there is relatively unimportant. So, the two prongs that I was talking about earlier are the retirement income that we want to establish for when the principal owner is going to hang it up, but we also want to get the significant tax deductions on the near term. And so if we assume that the plan is going to return 5% and there's actually a 20% return each year, well, that's going to limit the deductions that the plan sponsor could take in future years, because essentially future contributions, future deductions are eaten up by these investment gains. And that's why while we don't investment advisors, we don't give investment advice. A more conservative approach is good for both the low end for when there's a downturn and also when there's a big boom. It keeps the plan more in control. And obviously, it goes without saying that collaborating with Definiti as the third-party administrator, as the actuary, and the CPA to determine the contribution amounts year by year. So we would all work as a tripod along with the investment advisor. The CPA will say, here's what your income is, and as long as it can be supported, we want to put in as much as we can into the plan to get to defer that much taxes. But that's when we come in and we have the conversation that, hey, this is a brand new plan. Yeah, that might be a good idea to go ahead and fund as much as you can, and then we'll worry about it down the road. Or we might say, well, this plan is nearing termination. We might want to limit what we're putting into the plan this year so we don't get into an overfunded situation. So, like I said, ultimately, we're targeting a future goal. The idea is whether the assets that we're shooting for are made up of deposits and returns. How we get there is basically a balance between all parties, and just make sure that we're all on the same page of how we're going to get there. And just real quick, the other side of this is we have an underfunded plan. So obviously we look at these with dollar signs in our eyes and we want everything to grow, but that's not always the case. And there have been years where the liabilities continue to grow because that's how the defined benefit plan works. But there's been poor asset return and there's been losses, or these other examples that I already gave about some factors of why costs would increase. So if you find yourself in the underfunded situation in which basically the liabilities that have accrued in the plan are less than the assets, or more than the assets, I'm sorry, because that would be underfunded. There are certain ways that we can go about it. And obviously we would have a conversation with the plan sponsor to make sure that what we're suggesting is doable. Obviously the easy, quote easy solution there would be just, oh, I lost $50,000 in the market in last year in the plan, I'm just going to fund an extra $50,000 next year. It's not as easy as that always. one thing we can do is amend the plan prospectively. We can't do anything about what's happened so far, but we can amend the plan prospectively such that, instead of that principal in that example earlier getting 80% of her compensation as a contribution credit each year, maybe starting in 2022, she's only going to take 50% of compensation, which will obviously slow down the costs, which will allow the investments to hopefully catch up to what the liability is. We have one solution called a freeze, and you can either do a hard freeze or a soft freeze. That basically means as of the certain date that we amend the plan to be frozen, either a hard freeze in which no new employees are going to be coming into the plan, and anybody that's already in the plan, their benefits won't continue to grow. That's a hard freeze. Or a soft freeze basically just does half of that, where the people that are already in the plan as of the date of the freeze, they continue to earn benefits, but any new employees are basically locked out. And there are certain boxes that have to be checked to make sure the freeze will work for your plan. And then finally, when we get to the end of the plan, this is not something that can be done on an ongoing basis, but at the end of the plan, if there is a shortfall, and let's say we have a single owner cash balance plan that their benefit in the plan is accrued to $1 million. And we get to the end of the plan and their plan assets based on the investments and contributions are only 900,000. Well, they have the option as the majority owner to either fund that final $100,000, then quickly turn around and take the $1 million out, or they could forego, which is how it's written in the regulations, or waive down basically, just so your benefit is now 900,000, which is equivalent to what the plan assets say. This is only something that's available when you're terminating the plan. And so if you find yourself in a shortfall situation on an ongoing basis, we would need to look at one of these other techniques. So lastly, just to reiterate everything kind of we've talked about throughout this afternoon, really a successful defined benefit cash balance plan, whatever design you end up choosing, it relies upon the different legs of the stool. And so there's the three different tripod, I'll use that term again, and we're all working with the plan sponsor to make sure that we meet their needs. We as the Definiti, as the actuary, we're responsible for designing the plan up front, just based on the goals that are stated at the very outset. And obviously we do the annual administration, recommend the contributions, and figure out, strategy-wise how this is going to work. The CPA is obviously there, and there's probably many CPAs on the call today. You guys are obviously there to help determine what can be put in. I might say, hey, we recommend you putting in 200,000, but the CPA may say, well, I've reconciled your return for the year and you can only put in 150. And then we could have a conversation about that. And then obviously the financial advisor is responsible for having that conservative growth. And obviously that we would want to fit something that works within the plan's provisions that will grow, but not at a ridiculous pace. So naturally, we all have overlapping priorities and responsibilities, and it's obviously very important for us to keep that communication open. So I thank you guys for joining this afternoon. If there's any questions that have come in, I don't know through the chat if Leah has any, or if there's anybody who wants to ask any questions now, feel free. Our contact information, I've put it on here, so you can get in touch with Leah, myself, Don, and Dave. And I thank you guys for coming in this afternoon.
Thanks, Kevin. Thank you, Dave and Don. And again, if you have any questions, please feel free to contact us, or you can contact your retirement plan consultant directly, which can get in touch with us and get any questions that you have answered. So everyone have a great afternoon, and thank you very much for attending.
Thanks, everyone.
Bye-bye.